Right then, good afternoon, everyone, on Wednesday, the 26th of July, as we head into today's interest rate decision from the Fed. Now, obviously 7 o'clock this afternoon, well, this evening for UK time, this afternoon for US market participants. But 25 basis point hike is what to be expected. That is widely expected by markets. So we don't care too much about that. What we want is some forward guidance on what to expect for interest rate hikes going forward. Now, if we look back to the last meeting and think to ourselves that we had the dot plot at the last meeting. The dot plot did suggest two further rate hikes upcoming for the rest of this hiking cycle. Markets do not seem to believe that. Markets seem to believe that there will be 25 basis points worth of hikes going forward. And if and that's kind of what we need to look ahead for into tonight's meeting. You'd have to imagine he does maintain the stance of them being data dependent going forward, but something to note that he did since that meeting reiterate the fact that two ongoing rate hikes or two rate hikes at the next meetings would be appropriate still, and to not rule out the possibility of two 25 basis point hikes back to back, right? And that is sort of where we are at in terms of communication to markets. But obviously today's interest rate decision, mainly the press conference, will give us an idea of where we are headed going forward. Now, he is likely to maintain, or in my opinion is likely to maintain, the stance that the Fed are going to be data dependent going forward and have not made any decisions as to future rate hikes or non-rate hikes. So that to me would be a bit of a dovish step, comparing the dot plot saying two 50 basis point hikes, then to him suggesting they're going to be data dependent and haven't made any sort of decision. So my guess would be that he will say that. Now, the movement, I think, then comes off the back of, if that was to happen and he does suggest they're going to be data dependent going forward, and doesn't commit to back rate hikes, or doesn't even commit to 50 basis points worth of hikes upcoming. Obviously 25 will be done today. That would then be a reason for some risk on trading. You should see risk assets push higher. You should see the dollar then push lower. On the flip side to that, though, if he does maintain his 50 basis point hike stance and does maintain the fact that they're going to be another two 25 basis point hikes, or one then after today, that is likely to be a hawkish scenario, and it's probably a situation where stocks then push lower and the US dollar pushes higher. Now, if we just have a look at what is currently priced in to markets, we can see 96.5% chance of a hike this evening. So foregone conclusion, we're getting a 25 basis point hike. If we don't, there's a move for you, but we are getting a 25 basis point hike then this evening, right? No chance of a 50, well, 3.5 chance of a 50, but we're not going to get that tonight. Absolutely not, right? Then we need to look a little bit further out into the future. Now, the next meeting on the 20th September, you can see a 79.1% chance of the 25 basis point hike not being increased upon in September's meeting. Now, 20.3% chance of those back-to-back hikes coming in the form of, obviously, back-to-back 25 basis point hikes. Now, you can see a month ago, well, forget about a month ago, we look about a week ago, 84.5% chance of interest rates being 25 and then done. There's now a 79% chance of interest rates being a 25% hike and then done. You can see a 13.7% chance of 50 basis points being done, 25 and then 25 at the September meeting, and now a 20% chance. So a jump of nearly 8%. Chance of two back-to-back 25 basis point hikes. So markets starting to look a little bit towards, certainly over the last week or two, and certainly over the course of the last month, it's gone from 10% to 20%. So markets not completely closed to the idea of 25 basis points at this meeting and 25 basis points again in September, but we do need to watch for the rhetoric surrounding his press conference in order to figure that out. If we flick ahead onto November, you can see 59.6% chance of that 25 basis points being it until November's meeting, or being it at November's meeting, but a 35% chance of another 25 basis point hike at that November meeting, or let's say at that November meeting, a 35% chance of interest rates being 50 basis points higher than what they currently are by the time that November meeting is concluded. You can see a month ago the chances of two 25s 50 basis points higher, has gone from 16.3% chance up to 25, up to 34.1, and now sits at 34.8. So markets again, being open to the fact, or being increasingly more open over the last number of weeks to that being a possible eventuality. Now, that is what markets are pricing in. That's what interest rate markets are pricing in, that there is still a possibility for the Fed to be telling the truth, which they haven't done a lot of in recent years. I say haven't told the truth. They've been wrong on a lot of things in recent years. But that's what they have communicated to markets. It will be interesting today to see if he does stick to that sort of analysis. Does he think the 25 basis points twice is appropriate at the upcoming meeting? So kind of food for thought heading into this evening's meeting. I mean, as I said earlier, my opinion would be you'd have to kind of imagine that he would stick to the script of it being data dependent going forward. They haven't made any decisions yet, and they would make decisions as and when they receive the incoming economic data. I think it would be foolish to go and be like, bang, we're doing it. But I mean, you never know. He won't want to shake up markets too much, but he will also want to save face and stick to the script. So is there a possibility where he does come out and reaffirm a stance of 50 basis points, reaffirm the Fed's stance of 50 basis points, as we have to remember that is the Fed's stance at the moment, that we are going to see 50 basis points worth of hikes. Now, if they move away from that, that is likely to generate a move higher in risk assets. If he does stick to that, judging off the pricing that we can see here, that is likely to cause a move lower in risk assets. And obviously the dollar moves opposed to risk assets when we have a look at that. Now, markets to keep an eye on, I think certainly this 10-year yield, probably the 2-year yield as well, which will jump up on a chart at the moment. We'll stick it over here, and we'll keep our eyes away from the VIX. Let's have a little bit of a look at that, where we are at in terms of VIX. Just before I started this recording, we can see the 10-year over here, relatively sideways, not offering too much. You can see, the 2-year relatively sideways, not offering too much over the last week, obviously in anticipation for this release. The S&P continues to grind higher. US dollar or euro dollar grinds lower, the US dollar grinds higher. It's not a combination of things you likely see when the S&P is grinding higher and the dollar is grinding higher, but that is what we are looking at the moment. Gold moving slightly lower, not in terms of kind of yesterday and today's trade, slightly higher off the back of yesterday and today, but that has coincided with a slight bit of a pullback in the US dollar. So you can see a bit of US dollar strength, bit of stock index strength, playing out on a slight bit of gold weakness and euro dollar weakness as we head into this decision later on this evening. But I think one thing to keep an eye on is the move in commodities recently. We can see oil pushing higher. Oil continuing to push higher puts upwards pressure on inflation. You can see this commodity index right from the end of June up until now has been rallying pretty aggressively higher. Now, higher commodity prices, whether it's oil or whether it's all these other commodities, they do continue to put upwards pressure on inflation. And if those commodities continue to push higher and commodities continue to push higher, that is a situation where it continues to put pressure on inflation. And that is something that the Fed will not want to see. So they will want those commodities pushing lower, and they will have to probably think about that and think to themselves, like, they have to get inflation under control. They want to get inflation under control. Rising commodity prices is not conducive to inflation continuing to push lower. So that is a chart. These are charts that I'll be keeping an eye on going forward. Is this commodity index, is the price of oil, is the price of commodities, as that continues to put upwards pressure on inflation and will warrant further 50 basis points worth of hikes. Right, not too much more analysis we can really do into it as we head into today's session, today's decision. But the two scenarios that you need to look out for is 50 basis points, right? Does he stick to the script of 50 basis points worth of hikes? If he does, that is likely to push risk assets lower. You'd have to imagine markets begin to price in that fact. Whether they've priced it in fully is, probably not. Markets just don't believe the Fed at the moment and a lot of what they say. So in terms of what that moves, in terms of a longer lasting move, if he continues to stick to the 50 basis point script, I would say that's a spike lower in the S&P, and then you probably want to back out of those positions, and what that means going forward is a little bit tricky. If he does shift away from the 50 basis point stance and does commit to the data dependent going forward analogy, then I would imagine the S&P pops higher, and then you can continue to buy the S&P, continue to sell the dollar over the sessions ahead. So I think the easier trade is for the data dependent stance and pushing back on those 50 basis points worth of hikes. If we do get kind of further clarification, but more of a stance of 50 basis points going forward, I think it's a little bit more difficult of a trade. Should be fairly simple in the immediate aftermath. S&P lower, dollar higher, bonds higher, which then send yields lower. On the flip side, being data dependent, pushing away from that 50 basis point stance, should be S&P higher. Bonds lower, dollar lower, and yields higher. So that's something to think about going forward into this meeting. You could get markets moving in either direction, as we obviously have to await and see what he decides to say for himself. But sort of extracurricular to that, these commodity prices continue to put, or will continue to put, upwards pressure on inflation, and that is not good moving forward. And if he does reaffirm that 25 basis point stance, or does push back on the 50 basis point stance, and does commit to a data dependent situation going forward, do we get a pop higher in commodities? And a further pop higher in commodities is not good for inflation. So it can have some implications, and in the aftermath we really need to wait and see as to how markets react and what he has to say for himself. Once we figure that out, we will update a little bit more in the morning. But then get into your charts, look for levels worth paying attention to, see where you find yourself come 8 o'clock this evening after his press conference has been concluded. But that's where we're kind of sat at the moment. We'll wait and see what he has to say for himself at 7:30 in the press conference, as that is what we will need to watch out for rather than the actual decision itself. Once we have time to digest that in the morning, we will be back with another video before the European session in the morning, where we will break this down further and see what we think going ahead. But that's the idea going into the Fed later on this evening. There's a couple of different scenarios that may play out in order to take some assets in certain directions. We'll have to see what Jerome Powell has to say for himself at 7:30 tonight.